We have calculated a valuation for Geopacific of 11 cents per share. We determine this valuation by completing a detailed cash flow analysis on the company's Woodlark Gold project in Papua New Guinea, as well as giving a notional value for the company's other assets. A PDF version of our valuation and financial forecasts is available at the Sophisticated Investor website by clicking on the link. The key assumptions that we explain in further detail include our mine life, production rate and strip ratio, the gold price, as well as our capital and operating cost assumptions. We have assumed an initial mine life for the Woodlark project of 1.2 million ounces of gold. This is also the reserve target set for Geopacific to increase their ownership to 51%. We believe our mine life assumption is relatively conservative, given the project already has a reserve and resource of around 800,000 ounces and 2.1 million ounces of gold respectively. Geopacific also recently commenced a 3 drill rig program aimed at increasing the reserve. Whilst we also believe other aspects, such as the cut-off grade, will also be considered when the reserve is updated later this year. We therefore examined a range of extended mine life scenarios to see the effect on our valuation. However, with a mine life assumption already in excess of 10 years, it is likely that any further increase to the mine life will also see a potential increase to the plant's throughput. We therefore also examined a range of increased throughput scenarios, with the expansion being paid for from free cash flow during the first 2 years of the operation. Not surprisingly, under all scenarios our valuation increases. However, we note of the additional uplift when the expansion is also considered. One area that we have maintained in line with the DFS, however appears likely to have a significant reduction post the current drill program, is the assumed strip ratio. All things being equal, a reduction in the strip ratio would also see a reduction in the forecasted operating costs. We therefore ran a scenario to highlight the potential impact on our C1 operating costs, as well as the effect on our valuation if the strip ratio was to decrease. We will review this assumption in the near future. The US dollar gold price has fluctuated between $1,050 and $1,350 per ounce during 2016. We therefore have assumed a flat gold price of $1,200 per ounce over the life of the asset, which is the average price over the past year. But as with all commodities, the gold price will likely continue to fluctuate in the future. We therefore examined a range of different gold price scenarios to highlight the potential change to our valuation. We note that for every $100 per ounce change in the gold price, our valuation changes by around 3 cents per share. Since the previous DFS, which was completed in 2012, both operating and capital costs in the gold mining industry have fallen. We therefore reviewed both costing assumptions compared to similar sized operations and believe there is a potential for significant savings. We have reduced our initial capital cost to US $125 million. This is in line with capital cost estimates for gold development projects of a similar size. Whilst we have also reduced our operating cost assumptions, largely due to a reduction in processing or more specifically power costs. This cost is also likely to fall further in the future as the strip ratio assumption is also likely to decrease. However, as there is a degree of uncertainty regarding some of our assumptions, which will be further clarified post the reserve upgrade, as well as the release of the bankable feasibility study, we have completed a range of scenarios with both upside and downside potential compared to our base case. We found that even on the triple downside scenario, which we believe is unlikely, our valuation is still higher than the current share price, which highlights both the robustness of the project as well as the upside potential in Geopacific's current share price.